Good evening, everyone, and welcome to our introductory level class, Understanding the Jargon. My name is Ann Cunez. I'm the Education Program Manager at BetterInvesting. I will be one of your teachers this evening. I'm joined by Ken Kavula. He's the president of the Mid-Michigan chapter. Hello, Ken.
Well, hello, Ann. Glad to be here this evening.
For those of you that came to our Why Invest, we talked a little bit about why you would even be interested in investing in stocks, and talked a little bit about the power of compounding and how you might be able to achieve these goals. Tonight we're going to take that introduction to the next step, and we're going to talk about some of the jargon, some of the terminology that you might need to start investing. A basic understanding is what we're going to talk about there. We're going to talk about some concepts about your views of the stock market and how that might be influenced by your history. So this is our basic disclaimer. We're reminding you that these are for educational purposes only. We do not make, BetterInvesting does not make any recommendations to purchase or sell any stock equities. These are some headlines that as investors, we might target in on. We might look at those and think different things. But I wonder how many of you in the audience, if you're brand new investors, you may not even know what some of this terminology means. Stock market dropped 6%. What the heck is a stock market? The Dow reaches new high. Whether or not these mean something to you probably has a little bit to do with, how you were raised. If your parents were investors. That's, maybe going back for some of us, but I remember back in my childhood, my parents weren't big investors, but they did invest some. My dad taught me how to read the stock tables in the newspaper. I remember there was a project I worked on in school where we were introduced to the concepts and played a little stock game, and I was intrigued by it. So I had a little bit of knowledge as I was growing up.
I think what's important, Ann, is that these are the kind of headlines that you'd see in a general newspaper, and you might even see them somewhere on the front page, not on
Absolutely.
the business page. And the key is that many folks read this headline, don't understand quite what it says. They think they have a kind of a flavor for it, and then they move on to the sports page or the entertainment page or the editorial page, and business is done for the evening. I think we'd like to have our people understand what these headlines mean and maybe make them a little bit more curious as to where they'd get more news and specifically what's being talked about in a headline like this. I know a lot of times when you talk about the stock market to people that aren't investors, or even to people that are amateur investors or kind of now here again, there again investors, that you hear things like the stock market is a dart game, or investing in stocks is too difficult for individuals. I think we're here to present the other side to the story of these types of misconceptions, because I really don't view the stock market as any more of a gamble than any other investment that I might make. And I really do think that there's a strong possibility that as a good, solid, informed amateur investor, that I can make money in the stock market on a regular basis. I belong to stock clubs that have been around, for one of them for 20 years, and we have a relative return of about 4%, which means that we've beaten the market by about 4 percentage points for the last 20 or so years. I think that's a pretty good record of performance, and it doesn't take that much work for us to make it happen.
Well, that's very true, Ken, and I don't think you're alone in that. I think you can look across the country, and there are BetterInvesting members, both past and present, that would dispute all those statements, and especially those last two, that only professionals can make money in the market. We've got a lot of people, a lot of members that have proven that to be just not the truth. So today's agenda, it's very simple. We are going to take a look and introduce how the stock market will help you, or it provides you with this mechanism to help you share in company profits, to be a company owner. We're going to take a look at some of the very basic vocabulary that you're going to need to study stocks. And we're also going to take a look at how price is affected by perception as well as supply and demand. There's a couple things going on there. And we will introduce you and talk a little bit more on the Better Investing methodology and how we do provide a structure to help you evaluate and select the stocks to make a good investment.
So I think almost anything in business starts with a great idea. Somebody somewhere at some time has an idea that they hope is different enough that will allow them to sell whatever the product is or whatever the idea happens to be and make some money. And you know, the end goal eventually is to become wealthy and maybe to have a little bit of power, a little bit of prestige. I'm not certain that Zuckerberg, when he started Facebook, was thinking about making it a business, but I'm quite sure that as soon as he discovered how popular it was and what an addictive kind of thing this social media, this social networking was, I'm sure he started immediately thinking about how to turn it into a business with an actual revenue stream attached to it. So we start a business with a great idea.
And just like anything, when you're going to get started on something, you've got to put a plan together. When you start a new business, when Mark Zuckerberg thought about Facebook, he put together a plan and he said, you know, what do I need to get this off the ground? Whatever kind of business you're talking about, you're going to have different needs. You know, maybe you need a factory if you are manufacturing something. Maybe you just need some office and equipment, computer equipment. You need some parts, you need some employees, but you're going to have to put some kind of resources together, and to get those things together, it's going to take some money.
And the word that is paramount throughout all these things, Anna, as you start, is this word growth. And almost immediately, if your business is going to be successful, it has to focus on growing. It has to employ more than yourself and your brother-in-law. And it has to get out of your garage and get into a place where you can actually add the equipment and add the other people and add all the accoutrements that are needed to make the business successful. So we're looking for things that will help the business grow.
And so you have to raise those funds. You have to find that money to help you get started. Probably you've talked to a number of other people about your idea, and maybe they want to invest in you. They believe in this as a good idea, and they want to get a part of that action, right? They want to invest in this new business. So going out and finding these interested people, finding your investors, this is one of the main ways a new business will raise the funds so that they can start their business.
If you're going to invest in the company, however, you should get something for your money. You're, after all, taking a risk, because we know for a fact that not all new companies succeed in what they're trying to do. So in exchange for your funding of the new business, investors usually receive a share of the company. That's just a piece of the pie. You have a little bit of influence in the company, and that influence is probably related directly to either the amount of intellectual capital that you might have provided or the amount of actual financial capital that you might have provided. If you put enough investors together, then a new company has enough capital to actually form and begin to deal with whatever its product happens to be.
Now, I was going to add, when you were talking about investors, I want to make it clear to everybody here that when you do invest, and we're not talking about a public company at this point, it's a new company, but when you're investing in your money and receiving a share of the company, that makes you a partial share owner of the company. That's the word I'm looking for. You are a part owner of that company. You will share in, hopefully, the profits that are coming out of that. We've listed a few reasons why people might want to invest. I think the number one reason is profit. Maybe some people are looking for prestige and power, but I think really the main reason, the main driver is that people want to invest in something that they think is a good idea that is going to make them money.
I agree with you, Ann. What we've basically outlined here is in very, very simple elementary terms, is we've outlined the foundation of the capitalistic system. People want to do something in business. They have an idea. They go out and collect investors who give them money or intellectual product, and they form a business, and we hope they become profitable.
And that's the startup. There's some jargon that's not on the slide, but that's the startup company that maybe you've heard of. Then what's next? Hopefully, this company is successful. As Ken was saying earlier, not every company becomes successful, but if this company is successful, it will continue to grow. And when it continues to grow, it is going to need more funding to fund this expansion. And this doesn't always happen this way, but one of the ways that a company can expand, and expand quite a bit once they get to the point they want to do this, is to offer shares of the company to the public. This is known as offering an initial public offering. IPO is the acronym, the abbreviation that you're going to hear about that, and it's known as going public. You've taken your private company public. That is one way of raising the additional funds you need to grow.
And the other way that a company can raise the additional money needed to continue expansion is to actually go to a bank, or it might not even be a traditional bank. It might be some other similar type of institution, but the company would go and they could borrow funds as well. So they can actually sell a piece of the company, or they can borrow money to put to work. And the whole purpose, again, is this growth idea. The company wants to continue growing, and that's the only way the company will eventually give a consistent revenue stream, which we hope will result in consistent profits.
And of course, it's not an either or on that slide. Many companies do both. They take some of their shares and they take them to the public, and they may take a loan as well. So often that's done both ways.
We've tried to create a chart here showing you the basic differences between private companies and public companies. And if you had to have one rule of thumb, you could tell yourself that private companies are usually smaller groups of investors. They're usually of a fairly small scale, as opposed to public companies, which usually have fairly significant numbers of investors. Remember, we could call them shareholders. When a company reaches a certain size, it becomes kind of difficult for it to remain private, and many times the push is to move to the public domain. That's also a way for the founders of these smaller companies to turn some of their intellectual capital into actual money, into actual financial capital. There are exceptions to the rule. You folks might listen on television sometimes and hear a company called S.E. Johnson, which is advertised. They make Pledge furniture wax. They make a number of household products. They're quite proud of the fact that they're a family-owned company, and they are definitely a private company. And that means that the stockholders are people that they know, usually other family members and close friends, and the way that you buy or sell shares in that private company is directly from the company itself. Many times there aren't any shares available for sale at various times because the privately held company is quite content with the shareholders it has in a lot of cases. Now you contrast that to a public company where you would buy shares directly through a third party. You could occasionally buy those shares directly from the company, but usually that direct line to the company comes through some type of a broker, hence the term stockbroker, to deal with people that share, sells, share
Sell
selling
shares.
shares of a publicly held company.
We knew what you meant. Right. So
Thank
that's
you.
our third party, that new jargon that Ken just introduced, stockbroker. Another difference between a private and a public company is that the private companies really aren't subject to a lot of the regulation, the regulatory rules, filing rules more than anything. I mean, they still have to follow the law and all, that the government has. So they don't have the SEC filing requirements and that kind of thing. So there is less of that kind of regulation to deal with. The reasons why one would go private versus public, I think companies would almost prefer to stay private if they didn't need the additional funding. They have closer control of everything that they're doing. They don't have to answer to a board of directors or their shareholders. They don't have to worry about that. The rationale for going public, and this is the way most large companies do end up going, and we've already touched on it, is that big need to raise a great deal of money for their growth and future expansion.
Remember that it makes it much more difficult to find financial information about a private company. They're not forced to put out annual reports or at least to put out publicly read annual reports. They're not forced to file auditors' reports with the public. They can hold those privately. They can hold those and share those only with their stockholders if they choose. And that makes it much more difficult to learn how a private company is operating. The control in a private company is direct. It goes to the president, and they probably have a board, but the board is made up of people usually that are all part of the group that controls the company, and they all have a stake usually in how the company operates. You contrast that again to a public company where the board is subject to election, and those directors have a fiduciary responsibility. That's a fancy word, huh, Ann?
That sure
A
is.
fiduciary responsibility to the shareholders. That means that they're bound to run the company in the best manner they can for the benefit of their shareholders.
We start with the question, why are investors willing to risk money in a company? Remember, when you are investing in stocks and equities, there is that element of risk involved. We talked about that last week at Why Invest. But we're willing to take on some of that risk because we believe that we can profit from this.
You might compare this, Ann, to why would people put money into a true nonprofit organization? And if you're investing in a nonprofit, there are many, many reasons why you might do that, but the least of those reasons is to make money usually. You oppose that, or you contrast that to why do investors risk money in a public company? Well, they're trying to make money. They want to make money, and they're not apologetic about that idea.
So let's define profits. Where do profits come from? Well, I think it starts with what we call our top line, our sales, or our revenues. Those are all the monies that any company collects from the sale of their goods or their services. This is known as the sales or revenues. It all starts there. We call that the top line on an income statement. From that, we subtract all the expenses needed to build those goods, supply those services, house our employees. All companies have expenses. It takes money to make money. So we subtract all the expenses from the sales, and what we are left with are the profits. The profits can be termed net income, net profit, earnings. You're going to see all of this vocabulary presented from different companies. They're all basically the very same thing.
And for this simple demonstration right here, taxes are part of your expenses. Taxes that are paid to various governmental agencies are just another of the expenses that you would subtract from the sales. Once you have your earnings, you can call it net income or net profit, then the earnings are allocated to each share, and we'll call that the earnings per share, and you usually see that abbreviated as EPS. These shares are owned by the shareholders or stockholders, and these are the people that actually control the company. It might seem to you that owning 1,000 shares of a company gives you a pretty decent piece of the pie, but you have to remember that most of the companies that are public have the numbers of shares numbering well into the multi-million number of shares. Here's another way to look at profit. You have all of your sales or revenues in one nice big green box. That's the money collected from all the goods and or the services that you might be selling. All of that money comes into one nice big box, and then it's split into two pieces. Some of the money is used to pay expenses, and remember that includes taxes as well. And the rest of the money is called profit. And that's the amount of money that's divided up among the shareholders, and we come up with this piece of information called earnings per share.
Again, when we're measuring profit, this earnings per share, we keep hitting it over and over, but it's a very important terminology. It's used all over the financial markets, the financial news stations. They are always talking about this earnings per share. And that is simply dividing the company's profits by the number of shares outstanding, the number of shares of stock totally that the company has. That's earnings per share. That is the portion of all of the earnings, the net income, that is allocated to each outstanding share. So each piece, if there's $1 worth of earnings per share, each share is allocated that $1. Or to say it another way, if there was $1,000 in net income and 1,000 shares, then the earnings per share, I'm keeping my math very simple here, would be $1.
It's also important for us to understand that earnings per share are a snapshot in time. And that means that the earnings per share have to be calculated at some point. And so at some point, the number of shares is calculated. That number of shares value, however, is always changing. It's always moving up and down as companies award various numbers of shares to employees, or as they sell some more stock, or as they buy back stock. The number of shares does not remain constant, so we have to pick a point in time, and usually these earnings per share, the point in time comes 4 times a year, and that's every 3 months at the end of the fiscal quarter that earnings per share are calculated.
Right. I'm just going to add just a little bit to that because that's exactly true. It's about 4 times, but also I want people to realize that it is the earnings that have been earned in that 3-month period. It's a tally of everything that has happened in that 3-month period. So they're reporting out on that. Profits are very important because this is what it's all about. Over the long term, profitability starts with sales. You can't make money unless you've got something to sell. We believe that sales growth drives the growth of earnings. We believe that because we've seen it. And that the growth of earnings drives stock prices higher. Stock price is ultimately following those earnings. You're going to hear that over and over again if you take a number of better investing classes. Sales drives earnings, earnings drive stock price. That's why we really believe it's important to look at those sales and growing earnings, because that's where we're going to see our growing stock prices come from.
It's important to memorize this mantra. It's important for you to internalize this idea that earnings follow sales, that you sell something in order to make money, and stock price follows earnings, that the price of a stock depends on what it earns, and what the company earns depends on what it sells. Now, I don't care exactly how you memorize that idea, but that idea has to be internalized if you're going to truly become a better investor.
And people invest. We've said it before. We're here to make money. We're not just here for a hobby, although some of us enjoy it, but we are here to make money in the stock market.
It's so interesting, Ann. When I teach face-to-face classes, I'll stand in front of the class at the beginning many times, and I'll ask folks why they're in the class. And so often people will give me all kinds of answers that dance around the idea that's on this slide. And I have to remind my students constantly that while it's important that you learn, and while it's important that you refine your techniques and practice your techniques, the ultimate reason why you study investing is to make money.
You bet. You bet. And it's not, they shouldn't be shy about it. It's okay to admit that. The stock market, more jargon. If you don't know, have any idea what the stock market is, you can almost think of it, it's not a direct comparison, but think of it like a giant supermarket. It's a place where you can go, it's not really a place, but a virtual place where you can go, where they have all of the various stocks laid out for you to buy and sell. It's one location. If we didn't have this market set up the way we do, it would be very difficult to knock on your neighbor's doors and ask them if they had any extra shares of Apple that they wanted to sell you. So we have this stock market where all of the various stocks and equities are listed.
It's actually a fairly good analogy, Ann, because there are a couple of these supermarkets around, and they all sell slightly different goods, just like actual supermarkets all sell slightly different things within their supermarket. Here's the names of some of our most common supermarkets, and the ones that, as pretty conservative investors, we kind of stick to. We kind of tend to buy in these three supermarkets. Actually, we focus on the top two, and you've heard of them before. Maybe you haven't known what the acronym stands for. You've heard of NYSE, that's the way it's usually pronounced, and it stands for the New York Stock Exchange. Originally, it was a physical place in New York City near a tree on Wall Street, and this is where people would actually physically come to trade shares of companies with each other. It's grown to be a place that still has a physical presence, but there's also a large electronic presence associated with the New York Stock Exchange. The other large exchange we have is the NASDAQ. And again, that's the usually accepted pronunciation, and that's the National Association of Securities Dealers Automated Quotation System. And the NASDAQ originally was not a physical location. It was a virtual location. That means everything was handled electronically with a large number of computers. And the NASDAQ originally was formed to deal with, it had a real focus on technology stocks. So today, even though the original NASDAQ was made up of many, many small tech companies, today some of the giants in the industry, the Microsofts and Apples and Intels of the world, are still being traded on the NASDAQ exchange.
There's other exchanges, and exchange, that's another important word. Think of that as one of these supermarkets that we're talking about, the exchanges. There's a lot of different exchanges. This over-the-counter exchange for smaller companies is another. There's other ones all around the country and even worldwide. But as U.S. investors, and if you follow our methodology, you will find that you will be trading your stocks on one of those top two, the New York Stock Exchange or the NASDAQ, almost exclusively.
In fact, Ann, when I see a stock that's only being traded over the counter, that's many times a red flag for me to want to avoid looking at that particular company. Over-the-counter stocks are usually extremely small, usually fairly speculative, and they're pretty thinly traded. what that means is there's not many people trying to sell those stocks, and there's also not many people trying to buy those stocks. So it's very difficult to strike a bargain between very few investors.
Right. We should probably change that slide to say smaller companies to be very small companies. And you might think of some of those. Some of those stocks are what is known as penny stocks, and you probably want to stay away from those as investors.
Well, there are also things called indexes, and an index is not like a supermarket. An index is rather like a group of things within the supermarket that you kind of keep track of the total price on. I know that when we talk about inflation many times, the newscasters trot out the market basket of typical goods that a family of four buys in any particular week at a grocery store. Well, that market basket has a price associated with it, and there's also stock things in that market basket. There might be a box of cornflakes and 3 pounds of hamburger meat and 2 chickens, and you can make the list as long as you'd like to have. Well, these indexes that we're looking at are very similar, except they're all made up of stocks. The Dow Jones is the index that's the one that the newscasters seem to use when they're trying to talk about the market going up and down. But in reality, the Dow Jones Industrial Average, that's its full name, only represents 30 of the largest stocks in the nation. And those 30 stocks are tallied every day as to their value, and then the tally is manipulated because those stocks have done various things that we have to take into consideration, but we get an average of their worth. And as one or two of those stocks changes things dramatically, then the Dow Jones average changes, either going up or down. But remember, it's only 30 of the largest stocks. The S&P 500, in comparison, or in contrast, I guess, is made up of 500 stocks, and those stocks come from the New York Stock Exchange and the NASDAQ. Again, however, the 500 stocks are still focused on the larger sized companies, and in fact, there's a decided bent in the S&P 500 to financial stocks. They represent a significant piece of this particular index. So when the S&P 500 goes up, that means that a fair number of those 500 stocks have done well that day, or a smaller number have done exceedingly well, and the same thing's true when it goes down.
And we have a few other indexes here. The NASDAQ Composite. That is an index that is heavily weighted with technology stocks. It is the stocks that are traded on the NASDAQ, 3,000 companies, I believe. The Russell 2000, this is an index that measures the performance of smaller companies. So 2,000 of the smaller companies are reported in this index. And remember what an index is. I said it in my previous statement. It's measuring the performance of this basket of stocks. There's a lot of other indexes. The last one on that list, the BIX 100, that's our BetterInvesting Top 100 index, and that represents the top 100 holdings of the BetterInvesting investment clubs. This is an actual index that you can look at the performance. It's 5 years old, and you can look at the performance of this index.
Well, let's start with some more jargon here then. Here's ticker symbols. And if you're going to identify companies, then in the world of investing, we usually identify them by their ticker. We will talk about Apple, but when you see AAPL, you have to know that that's the symbol that's been allotted to Apple on the exchange where it's traded. And Apple is traded on the NASDAQ exchange. Harley-Davidson trades by the symbol HOG, H-O-G. So you see that companies are not above making a little bit of a joke, dealing with the products. Molson
It's
Coors.
branding. It's not a joke. It's branding.
Molson Coors with a ticker of TAP, and most of you understand what Molson Coors' basic business is. And then many companies, of course, stick with just the alphabetic character of their name. So Abbott Labs comes out as ABT.
So this is the company information that you might see. This is actually pulled from the source of Yahoo Finance when you bring up a quotation page. There's a lot of information, and we're going to introduce you to some of these pieces of information. But at the very beginning, I want to point out that here we've already talked about the names of the companies. We see that this is a quotation page for FactSet Research Systems. It's followed by its ticker, so it's shorthand, its abbreviation is FDS. We see that this stock trades on the New York Stock Exchange. We can read that right on there, and we can then read through and see the rest of the pricing information and various other things.
There's actually an awful lot of information within this block, and some of it is extremely important to investors, and other information is not nearly as important. So let's try to focus on some of the things that as beginning investors you might really want to take a look at. What I've done here is I've taken 3 of the companies that were on our list, Abbott Labs, Aflac, and Coach, and I've created a report showing some of the things that you can get off of Yahoo Finance about the stocks that you're studying. I've circled a piece of information, and we'll start right there. When you're on one of these websites on the internet, or for that matter in the newspaper, one of the most important pieces of information is the price of the stock. And when the market is open, and when you're on an internet site, that price number will change on a regular basis. Each time somebody trades some of the stock for Aflac, for example, that number, $51.79, will change just a little bit. It might go up a couple pennies, it might go down a little bit, but it will change after every single trade because each trade is unique and the price that they settle on for each trade is unique. Once the market closes, then the last trade of the day is reflected in the price column. That price will not change until the market opens again the next day, or if it's a weekend, it'll be the next Monday that it will open again.
That's what the next slide shows, that closing price.
Okay,
when the market is closed, that trading price, and that really is always the last trade, so just depending on if you're looking at it between the hours of 9:30 a.m. and 4 p.m. Eastern Time, that will be a trading price, a daily trading price. If you're looking at it outside of those hours, it'll be the closing price of that day.
And I think you should be aware also that between 9:30 and 9:45 or so, the price might be stalled a little bit. It takes a little bit of time to get the data into the system so that the price begins to move, and that price might keep moving from 4 all the way to 4:15 or even 4:20 some days, depending on how much trading action was actually happening. We see in the next couple of columns the change or the price change, and usually on a lot of these websites the folks use a green color to indicate that the stock has increased in price from the previous day's close, and they use a red color to indicate a decrease. The way that I would interpret this information right here is that Aflac has moved up 18 cents from the previous day's close, and that represents about 1/3% increase in the price of the stock. It's very important to look at your increase in percentage terms because stocks have such widely varying share price amounts. If Apple stock was moving up 18 cents, that would barely be any change at all. And if Abbott is moving up 18 cents, obviously that would be a higher percentage than Aflac moving up because Abbott's moving from a lower base.
Moving across the column there, you'll often see the numbers for the 52-week range reported. And this is simply the highest price and the lowest price that the stock has traded for in the previous year. And so you can see in the case of Aflac that the current price of $51.79 is actually closer to the 52-week high than it is to the low. So you can just kind of gauge where it is in its 52-week range.
The next column represents EPS. Remember, we've decided that stands for earnings per share. And this is not many times a yearly earnings per share number. It's virtually always a TTM. I'm going to say those letters again. It's a TTM.
Well, let's say that whole thing
number
again, because it is a yearly number. It's a year's worth of earnings.
Absolutely, but it
may not be
it represents the most recent 4 quarters.
Correct. And you did, anyway, I just wanted to clarify that so people understand that it does represent a year. Ken's absolutely correct. TTM, trailing 12 months, that's 4 quarters, makes a year. And just be aware that if the company has reported a quarter or 2 quarters or 3 quarters into their current fiscal year, that it will be different than the fiscal year. The fiscal year is when they officially close their books. Say that's December 31st. Sometimes it is, sometimes it isn't. So then in June, when 2 quarters have been reported, you would have the 4 quarters that were consecutive, the last 4. I was rambling there. I was listening to myself. I'm not sure if that made sense, but hopefully there was a little bit of differentiation between a fiscal year and what is the most recent 4-quarter yearly number.
We've skipped a column, and we'll come back to it in just a moment, but we've moved to the dividends per share column. And a dividend is how much of the earnings per share is a company paying directly to the stockholder. In this case, Aflac is paying $1.40 of its earnings directly to the shareholder in the form of a dividend. If you would happen to see a dash or an N/A in that column, that would indicate the company does not pay a dividend, and that's relatively common, especially among the kinds of stocks that better investors tend to look at.
Another really important concept is this concept of PE, or price to earnings ratio. It's a common ratio that we use to help us compare the valuation of stocks. It is a ratio is a fraction. Aflac, we see the PE column there, it's about 8.5. So where does that come from? Well, it's a little bit of math, but it is the P, price, divided by the earnings, so the price, he's circling, $51.79, divided by the earnings per share, our trailing 12 months of $607, gives us our PE value of $8.51.
Now, for you folks that are engineers in the room that have whipped out your calculators to verify this calculation, I will tell you that $51.79 divided by $6.07 does not give you $8.51 exactly. And that's because the PE column is fixed as of the end of the trading day prior. So that $8.51 is not based on the $51.79 price, but it's based on the price at the end of the trading day yesterday, and as you can tell, that would be 18 cents lower than reported.
And the engineer in you, Ken, did you check that math? Was that correct?
I did.
Then?
That's why I knew that was true.
That's good. Very good. All right, so here's some conceptual things and why we think price to earnings ratio is so important. It helps us understand how a particular company is being valued by investors. And if we think of the price earnings ratio as how much an investor is willing to pay for a single dollar's worth of earnings, it allows us to compare two stocks side by side, one selling at $60 and one selling at $32, but yet know how they are being valued by the market. Now, I use those numbers because Coach, in our example there, a $60 stock, its PE is 17. So that means people are willing to spend more, $17 for a dollar's worth of Coach's earnings, than they are for Abbott, which is around $30, and their PE is only 8.
If we were forced to ask you the question, what is the most expensive stock on this list, then most of you would move to the price column. We don't want you to move to the price column, however. We want you to move to the PE column. And we want you to determine whether a stock is expensive or inexpensive based on its PE value. So in this example, Abbott Labs and Aflac are really very close as far as expensive inexpensive is concerned. They're both trading at PEs around 8, while Coach is running more than twice as expensive as either of those first two stocks because its PE is around 17. Let's practice these terms if we will. We'd also like to get you used to using the question box, so if the urge strikes you to type in an answer or two in the question box, go ahead and do it, and Ann will tell us about the answers as they come in. Here's an expanded chart listing a number of different companies. So if I asked you the question, what's the trailing 12 months earnings per share for Coach? Could you find it?
Hopefully your eye is moving over to that earnings per share column and see it lined up with Coach. And yes, the answers are coming in, and you can just say these answers in your head. It's not a quiz, but if you want to type them, and everybody's getting it right, 357. Perfect.
We have a very smart class as usual.
We do.
How about, can you tell me the percentage gain in the price of Jack Henry this trading day?
The percentage gain, so that would be that change. And I see that we are reporting 32.32%, not 32%, about a third of 1%. And everybody, I haven't seen a wrong answer yet. Perfect.
Great. What's the symbol for night transportation?
Our ticker symbol, our abbreviation. And I see that they are coming in very well. They see that that's KNX. Absolutely correct.
And what's the name of the company with a COH ticker symbol?
Okay, so let's look in our symbol column, find that. Oh yes, they're all saying Coach, Coach, Coach. Absolutely.
What's the 52-week high for Microsoft?
Okay, that would be our range. Find the Microsoft line. What are we seeing here? Okay, I do see $32.95. We can't get anything by them. $32.95. They're all perfectly correct.
And at the last trade, what was Abbott trading at?
Okay, here we are. 32.83. That's right. 32.83, 32.83. Very good. They're all getting used to reading these charts.
What kind of a dividend is paid by Cognizant Technology Solutions?
Dividend, let's see. Cognizant. Nada. You can't get anything by them, Ken. That was a trick question.
And here comes the last question on this slide. Can you tell us what the least expensive stock on this list is?
Least expensive, as in how it's been valued by investors, right?
I think that's the question, Ann.
Yep. So we went through that, and I'm seeing a lot of Abbotts. I see Abbott.
So we couldn't tempt anybody to go for night transportation, could we?
With that $15 stock price. We didn't fool them. Nope.
Great, great. This is just a simple demonstration that these charts are important and you can get great information from them. They will become your friend. Don't be afraid to use them. We need to understand that the stock market is an auction. And most of you have experience with auctions. If you haven't actually been to one, you've watched them at various times. You've watched people auctioning off things. And I'd like you to do a little bit of thinking. What happens in an auction when there are a lot of bidders? When the room is really crowded, what happens?
Well, I hope they're kind of thinking that if there's a lot of people in the audience bidding, that means that the price might go up. A limited supply and much demand usually makes a price go up.
We have to make sure, however, that the people that are in the room are actually seeking the goods that are being sold.
That's true. They have to want what you've got.
So, if there are many sets of identical merchandise, what do you think that might do to the auction?
Well, thinking about that in supply and demand, I guess if there's lots of sets of the same stuff, lots of supply, that might mean demand would be lower and I'd be able to get it at a better price. The bidding might not go as high.
But also, we could think that if they're all the one thing that everybody is looking for, even though there are 15 sets of it, people might really bid those 15 sets up real high. Let's say it's a particularly valuable baseball card. Now, ideally, people should understand that if there are 15 of them, they're not worth as much as one of them all by itself, but many times the emotion will take over and those 15 things might just fly off the shelves in that auction.
Yeah, you're just pointing out that there's two sides to every one of these arguments here.
I think we're talking about the fact that supply and demand plays an extremely important part in this stock market auction, but that emotions play just as important a part.
And desirability. I mean, this next point, there's only a few people in the room. What happens? And when we talked about this, we had a discussion and we said, it depends. There's only a few people in the room. Well, it could only maybe take two people to bid a particularly desirable item up and up and up. It could go to sky's the limit if they really want it. On the other hand, if there's only a few people, they might not be interested in the merchandise that's being auctioned off, and then it would fall flat.
Well, I hope we've made our point that day to day, the stock market is not very efficient. If it were completely efficient, then it would run completely on supply and demand. The more the supply, the lower the price. The less stock available, the higher the price. But we know for a fact that emotion can create opportunity on this day-to-day auction. And that's why we think that you're able to buy stocks at prices that do not necessarily reflect what their actual value is.
Well, that's the key. I think that we all realize that over the long term, the sales drives the earnings drives the price. So your stock has a basic intrinsic worth. It's worth a value. But on a day-to-day basis, things can go in and out of favor. Emotion can create lots of opportunity, both buying and selling opportunities. Sometimes stocks go so ridiculously high that you have to sell if you own them because you just can't not take that profit. On the day-to-day, the stock markets is not efficient, but over the long term, we believe that it does come back to its senses and drives that value with the earnings. So let's think about some of the things that might drive these prices to go wildly up or wildly down. There's a lot of different things, and they're listed here. Your stocks, they don't just exist in their own little bubble. They're going to be affected by broader economic things, industry issues, competitors' good news might make your stock rise up for no real good reason at all. Some of these things are very particular to the stock that you might be holding. Like if you hear about a death of a CEO or a sudden management change, yes, that can have a quick surge or decline in your stock. But
I
some
know
of these
those
are
of
completely out of the control of the company is the point I'm making.
I know those of you that listen to CNBC on a regular basis listen to people that are always telling us a reason for a stock going up or a stock going down. But I like to remind people that that last reason is a very good reason why a stock goes up or a stock goes down sometimes. Nothing at all discernible is happening, and still the stock might take a sudden spike up or a sudden spike down. It's important for us to understand that we can't come up with reasons why everything happens in the stock market.
And this is probably why most of us don't like to look at our stocks on a tick by tick basis.
So where do we go from here? Well, we know some investing terms, some basic jargon, and it's important to speak the language of investing when you're with other investors. You know, when you're sitting with an experienced investor, folks, if you hear language you don't understand, I don't know of anyone in the better investing community that won't stop the point they're making and explain the vocabulary they're using. So don't be afraid to stop somebody and say, what exactly do you mean by, and then ask your question. None of the questions that we hear are bad, and the only questions that I think are going to cause you problems are those that aren't asked. I hope you're beginning to understand a little bit about market psychology, about this idea that supply and demand is very important, but so are the emotions that come from all of the people involved in the auction itself. Is there an investing methodology which allows us to invest for the long term? Well, I hope we can say yes. And are there tools which will help us make these decisions? I know we can answer yes to this as well.
Which is bringing up our better investing methodology. And we do have our 4 principles that we will review quickly here. And the first is to invest regularly. All that means is we want you to regularly invest in the market, whether the market is up, whether the market is down. Continue to put your money in. And regularly can mean as much as once a month, twice a year, once a year, whatever you deem that to be. But we don't time the market. There is the saying, it's not timing the market, it's time in the market that we are interested in.
We also believe that all dividends should be reinvested. So any dividend that might come from a stock, any extra money that might flow from a stock, spin-offs, things like that, we believe that they should stay in your portfolio and be reinvested into your portfolio. Now, that doesn't necessarily mean that if Coca-Cola gives you a dividend, you have to turn around and use it to buy more Coca-Cola stock. What it means is that that money from the dividend should stay in your portfolio and should be used to buy more investments that also will stay in your portfolio.
And we focus on buying high quality growth stocks at fair prices. Our tools help us learn to do that. We have to realize what a high quality growth stock is. When we're talking about that, we're talking about a company that is growing at a rate higher than inflation. Okay, so there is an element of growth to it. Quality speaks to how consistent that growth is, and we get into that a lot when we start to begin to learn the stock selection guide. But that's our focus. You buy high quality growth stocks, and it really helps you have a very profitable portfolio.
And finally, we believe that you should diversify. Not only the kind of diversification that is self-evident, don't put all your eggs in one basket, which to us means buy stocks in a number of different industries, but also the kind of diversity that comes from buying smaller stocks, medium-sized stocks, and larger stocks. The risk inherent with buying different classes of stocks is there. You have to understand that larger stocks are less risky as an investment than some of the smaller stocks. But you also have to understand that the reward that comes from buying certain classes of stocks varies as to size as well. So we want you to diversify by industry and also diversify by size of stock.
The stock selection guide, which we've referred to, is our main stock analysis tool. And it really provides us a framework to identify and evaluate the things we've been talking about, the sales and the earnings of the company. And it basically boils down to two simple questions. It helps us determine, is the stock a quality growth stock? And is the company or the stock selling at a fair and reasonable price at the current price? That's what it helps us answer, and it does help us frame all that information and consolidate it and help us focus on those two questions.
And what's so important for beginning investors to understand is that you have to get a yes answer to both of these questions before you're looking at a good investment. It's not enough just to find a high quality growth stock. You have to find a high quality growth stock that's selling at a fair and reasonable price before you put your money down.
And so we also want to point out the stock selection guide is a tool for us. It helps guide us in our judgments, but it's important for you to realize that the SSG is not complete without your judgment being added. The SSG is not a black box. It doesn't, as much as you would like to think, it looks so technical and there must be an answer in there. It doesn't just give you the answer. You must add your reasonable judgments to determine if the stock is selling at a reasonable price.
I know those of you with technical backgrounds understand the term black box immediately. For those of you that don't have a technical background, for a lot of people, a switch plate on the wall is a black box. All you know is that when you push the lever up, the lights go on, and when you push the lever down, the lights go off. Well, the SSG is not something like that. You can't just push numbers into one end of the SSG and have the words buy, sell, hold pour out the other side. The SSG requires your intimate association with it, and it requires your judgment at every single step along the way. So let's recap. You buy stocks to make money. The stock market is a way for you to share in the profits that come from different companies. There's basic jargon, basic vocabulary that you must know if you're going to seriously study stocks. Price depends not only on supply and demand, but it depends on perception and emotion, and sometimes to a great extent. And the Better Investing method provides a structure for evaluating and then selecting stocks for maximum return. We'd like to thank you all.
Thank you. Good night, all.